Hi, I'm Dan Cofall sitting in for Dan Stewart. He'll be back on Tuesday. Rest assured we haven't lost him yet. Don't be confused by the headlines that you're seeing today. The unemployment numbers were, the low expectation for unemployment was lowered early this week. Well, today we met those lowered expectations. Growth in the private sector still has not returned yet. But here are the two things that they didn't report that are important for you to know. If you went to the BLS, the Bureau of Labor Statistics report, which I get, read through it completely today, and you notice two statistics that really jump out at you. Number one, the average worker worked less hours in June than they did in May. Number two, the average worker made less per hour in June than they did in May. Those are the statistics that you want to pay a lot of attention to. Those give a much better indication as to trends. Stay away from the headlines, stay away from all the green shoot conversation, and pay attention to the absolute basics. For example, I had a good friend of mine ask me just today if I saw any positives in the market at all. I do not. If we assume that on January 1, the Bush tax cuts are reversed, the average family in America, let's just say making $200,000 a year. Now, that's not necessarily the average, but that's certainly within the president's range of what middle America is. That family making $200,000 a year is going to pay approximately $10,000 to $15,000 more in income taxes next year. Now, you say that isn't much, but here's the problem. If you take $10,000 away from the average family in disposable income, and they could go out and borrow money at, say, 5%, let's say a mortgage. If you take $10,000 away from them, you take away their ability to support $200,000 in debt. Now, think through that again. That's $200,000 worth of borrowing capacity we're taking away from people because we're going to tax them next year. What that means is housing, crushed. New cars, crushed. Any big ticket item, crushed. And here's the most important thing. You're going to hear politicians say, well, if you're making $200,000 and you just pay another $10,000 or $15,000 a year in taxes, it really isn't that much of a percentage. Let's consider what percentage it is of the average family's disposable income after they pay their mortgage, after they pay their cars, after they feed their family, after they pay for schools and clothing, etc. How much disposable income does the average $200,000 family have left at the end of each year? And if you say it's a lot more than $10,000 or $15,000, you'd be mistaken. So these tax increases are going to represent arguably nearly 100% of the average family's disposable income. Now you tell me how that's going to foster jobs, growth, home sales, home appreciation, new car sales, motorhome sales, any sort of personal consumption. There is nothing on the table that said these tax cuts will not be rolled back. And this is just the income tax rate. So when I look at this, I think the market, the situation that we're in right now, where we've had this market have a pretty good correction in it, I think the market's looking to January and February of March of next year and how little money the American consumer is going to have left. Remember, national health care will take a bite starting in 2011. Cap and trade may take a bite out of your utilities, increasing your utilities, the rollback of the tax cuts. Everything is about disposable income. And when you see how fragile the percentage of your disposable income is to your gross income, you realize that any change in taxes, any change in utility bills, any change in anything dramatically cuts into your disposable and investable income. So start thinking now about how you're going to preserve your wealth today, preserve your purchasing power. This is all a game about purchasing power. It's going to be interesting to see how the Congress, the President, but more importantly the voters in the fall react and what kind of changes they make to our Congress and maybe ultimately to our administration. Hard choices have to be made. Americans aren't going to like any of the choices that are facing them. But you as an investor, remember, you run off of the earnings of the companies that you invest in. Companies are going to be strained for earnings because they're going to be strained for sales and for consumption. It's the way I see it on Friday. Danny will see it different on Tuesday. Hope you all have a nice 4th of July. Thank you very much for checking our video out. Look forward to having you back next week. I'm Dan Cofall.